All right, get ready for what could eclipse every stock story, maybe when it comes to moving the markets tomorrow. The Labor Department releases the January jobs report. The U.S. economy expected to have added 50,000 new non-farm payrolls for the month. But you know what? Let's tee this up with one of Wall Street's most widely followed chief investment strategists, Charles Schwab's Liz Ann Sonders. She assists the firm on how to invest its $6.7 trillion worth of client assets. Liz Ann, great to have you. You know, we had December and it was an ugly surprise loss of 140,000 jobs. What are you expecting tomorrow?
Well, we don't attempt to forecast these numbers, even in a normal environment, let alone with the vagaries of trying to calculate this stuff
Yeah.
accurately. So yeah, I mean the consensus is 50. I haven't heard anything resembling a whisper number because I think it's difficult to do that. But I really think what's key on these Friday jobs reports are not just the headlines of payrolls and the unemployment rate, but one level lower that I think reflects the scarring impact of COVID. So I'd be focused also on the differential between temporary job losses and permanent job losses. Until last month, they were moving in the wrong direction, meaning permanent job losses were going up. That's an impact of scarring. And then also with regard to the unemployment rate, what percentage of those that remain unemployed have been unemployed for more than 27 weeks? That's considered long-term employment. So those aren't the sort of sub-level numbers that tend to get much interest or focus. I think in this unique period of time, those, in addition to the headline numbers, are what I would keep an eye on.
I could not agree with you more. You know, I was looking deep because we're nerds. I was looking deep into the first-time jobless claims number, and the one thing that really jumped out at me was that, and we got a lot of gig economy workers who watched the show. There were fewer of them joining the unemployment rolls for the first time, and fewer on the continuing claims line. They don't get the usual unemployment benefits, but because of the CARES Act, they were able to. That's certainly a good sign, but you've got to tell me, from your trained eye, is there any vulnerability or plural vulnerabilities that you see that we should be really focusing on, but they're hidden?
Well, and this is a broader answer, not just specific to gig economy workers. I think the narrative that exists now, especially since early November when we got the initial positive vaccine news from Pfizer, is that even though we don't know with any kind of time certainty when we will be largely vaccinated and be able to start to move toward whatever the post pandemic norm looks like, but part of that narrative is massive pent up demand. And I'm not so sure there is as much validity to that argument. I think on the good side of the economy, a lot of that demand has been met throughout, whether it's housing, housing related, home improvement, autos,
Hmm.
electronics. So I don't think you're going to see as much pent up demand from that point up. I think on the services side, if you just think about the nature of pent up demand on services, if you missed 8 haircuts, like I have over the COVID period of time, your hair salon opens back up, you get a haircut. You don't get 8 of them.
Yeah,
You probably don't recover all your restaurant visits by going out to make up for it every day for breakfast, brunch, lunch, tea, dinner, dessert.
sure.
So there's a different nature of pent up demand on the services side. And then the big question is there sort of an unleashing by virtue of this crisis in a greater focus on maintaining sort of a comfort nest egg, maintaining a higher level of savings. So some of the narrative around the
Hard to do.
surge we're going to see in economic growth is that all of this excess savings will come back into the economy. I don't know, but I think these are
Yeah.
just questions we're going to have to get answers to.
And some of them, that excess money went into, obviously, what we have now seen play out with the Reddit rebellion. That some of those stocks are starting to look like they're waving the red flag. I know you don't talk about
Oh yeah.
individual stocks, but as we put up GameStop, because that was certainly one of the favorites, this was a $483
Yep.
stock. Folks, it is at its session low right now. It is down about 38%, below $57 a share now. These darlings are really kind of collapsing, at least some of them. What does this say, Liz Ann, about how the markets may feel, react? What can people expect as we see the momentum come out of this drama that we've seen?
Well, keep in mind they were darlings for a very, very condensed period of time, and other than having sympathy, of course, for anybody that might be a novice trader that got sort of, sucked into this and lost money. We all have sympathy for them, but it was such a condensed period of time with, I think, lessons being
Yeah.
learned very quickly without the kind of systemic collapse that occurred, say, in the 2000 period. So I think it's sending an appropriate message that there's a huge difference between very short-term gambling and speculating, especially if it's not based on fundamentals, but sort of the greater fool theory of I'm just hoping to buy and then sell at a higher price tomorrow, versus long-term fundamental investing. I think it's wonderful that we've attracted interest in the market by younger traders and investors. The key is bridging that gap from short-term speculation to
Yeah.
understanding the difference between that and long-term fundamental investing.
Liz Ann Saunders of Charles Schwab, great to see you. Thank you so much.